Okay, hi. Sunday morning. Wanted to do a little recap of week 8 and then lead us into week 9. I won't talk about the allocation assignment. I got a number of calls from people, so I'm assuming that those who didn't call had no problem with it, and those that did call now understand how to do it. So if there are any lingering questions with that, just give a call. Be happy to speak with you. I really want to focus on the CTC case study because it's the third case study in a series about the importance of thinking out the financial implications of blindly trying to maximize mission. That's what my little note there says. Right, we had monotony case study where they intentionally spent down their cash in order to buy property and equipment, in order to expand services, in order to maximize mission, and we had and then they ended up in a cash crunch, right? We also had the New Stage Theater, where essentially the executive director there arrogantly decided what plays to present the public, and we'll figure out the money later. We also use that case study to think about the importance of the financial structure of an organization, and we discussed how a New Stage Theater came up short in each of the 4 structural areas: the organizational structure, the policies and procedures, record keeping, and integration of and complementary nature of financial and operational strategies in support of mission maximization. And so now we have the CTC, and let's see. Basically, Ron, the exec director, is clueless about the importance of watching and managing your cash. My guess is that, just from reading it, and it's hypothetical, but just reading it, Ron looked at the state and government budgets and said, oh, this is a fantastic opportunity for us to expand services. Let's see, each one is over $600,000, and let me look at the budgets here. Okay, here, revenues, yeah, okay, 600,000. And what are the expenses, guys? Oh, the expenses, are about 600,000. So we're not going to lose any money on either of these budgets, right? Because we got enough revenue coming in to cover our expenses. Oh, perfect. This is great. Let's sign the contract and whee! All the way home. So he never really gave a thought to when he was going to have to pay the bills in these contracts and when he was actually going to receive the money from the government to pay those bills. Okay? Let's see. And with that omission on his part, yes, he brings his little nonprofit to the brink of financial ruin. So, after the fact, you can, in the case study, you can figure out, that he's got some cash flow problems because you just look at the financials and you see that he's owed a lot of money. Accounts receivables is off the chart. And then you also see that account payables are off the chart, right? You find this in the which statement? The statement of financial position. But as a manager or a leader of a nonprofit, you need to be able to think ahead of time and anticipate what the problems might be, right? And this is where it separates good financial managers and good executive directors from poor ones, right? Because you can't react to the problem. You need to anticipate it and avoid it. And so in the case study, and so anytime that you are expanding or anytime you are undertaking something new, you want to make sure that you think about, well, when's the money going to come in and when do I have to pay it out, right? Think beyond whether or not the new endeavor is simply profitable that your revenues are going to cover your expenses, think about the timing of when those revenues come in and when the expenses go out. Because if you hear anything about time lags in payment, your red flag should go sky high and say, let's look at this a lot more closely. My CFO, I want an 18-month cash budget from you, a projection out as to what this new endeavor is going to do to our cash flow. Okay? And if you look closely at and so that's why in most of your postings, the initial postings, I wrote back to most of you, can you identify the source and the size of the cash flow problem? And you can actually do that in the case study if you look closely. I'm going to start reading at the bottom of page 292 in my book, down here. And then you can see I've marked the critical paragraph there. But it says, during the fiscal year 2005 and 6, payments from the federal and state government would constitute the largest source of operating income, as shown in the following table. Okay, and then there's a table at the top of 293. And then it goes on and says, payment was usually received 1 to 3 months after billing. At the end of the fiscal year, federal regulations required an end-of-contract accounting. Payments for the last month was usually delayed an additional 1 or 2 months. The state government was the major source of income. It, as well as payments for as well as parents who paid a portion of their children's expenses, was billed at the end of the month in which the service was provided, and payment was generally received within 30 to 60 days. Okay, so at this point, flashing lights should be going on and saying, holy smokes, wait a minute. First off, I'm gonna submit the bill at the end of the month that the service was provided. That means that whole month you're paying out money on expenses to do the operation, but you haven't even billed yet. Okay? And then the second part is that there's a 1 to 3 month lag on the federal contract, and there's up to a 2 month lag on the state contract. So let's just do quick calculation, right? We've got each contract is about $600,000, and if you divide that by 12, you know that the state, each one then is basically a $50,000 per month contract. So here's the Fed, here's the state. We're just going to use round numbers here. So that means that in total, these contracts are about $100,000. Okay? And what we just heard was that the federal government is sometimes up to 3 months late. And we heard that the state government can be up to 2 months late. So that equals if you multiply it out, 3 times 50 is $150,000 late, and the state one is 50,000 late. And actually, remember we said that the billing comes after the month the services are provided, so you can actually add in another month here. So this the federal one could actually be 200,000, right? 4 months behind times 50,000, the cost of each month's service, and the next one is 100,000, or 150 actually, right? 3 times the 50 is the state, gives you the $150,000 lag here, for a total of, oh my God, $350,000 lag. Are your eyes popping out? Are Ron's eyes popping out? He doesn't even have a clue, right? Because he says, well, I took out a $75,000 loan, and then I took out, what, another loan up to $100,000, and I still can't pay off my bills. Well, of course not, because you've got a permanent problem here of a magnitude that you got no clue about. Okay? Now, this was a very rough, not precise estimate, but let's see. Alicia took a stab, and a couple of others of you took a stab at the cash flow amount. Pamela did a wonderful, very detailed Excel sheet of the cash flow the cash flow problem. I'm going to add to this announcement another detailed cash flow analysis that goes 18 months, and it does try to really take into account that you have to pay salaries right in the month that the service is provided, because you can't stiff your employees. But maybe you can lag some of the other payments. Even so, you'll note at the very bottom of the spreadsheet in the yellow band a format that looks really familiar, or should seem familiar. It's the same format that's at the bottom of the Tri-City Academy account that we had, or assignment that we had at the very beginning of the course, right? Beginning cash, cash coming in, cash going out, cash at the end of the month. And you'll see that once you get into the contract a couple of months, the cash flow is well over 200,000 and sort of hangs around 280, 290 thousands of dollars in the hole, and that given that extra lag time at the end of the year that the federal government requires to do the closeout, you actually end up with 1 month where your cash flow is in the hole 350,000, like what's on this very simple estimate. And so the point being, again, when you think about any changes in your operational environment in a nonprofit, actually any organization, but particularly a nonprofit, you have to think about cash flow. And if you don't, particularly at times of growth, you really put your organization at risk. And this case study is to really drive that point home. The other thing about this particular case study that some of you noted, which was fabulous, is that the cash flow problem created by the federal and state grant or contracts really jeopardize CTC's United Way funding, right? Because United Way has this stipulation on it that you cannot have more than $5,000 of assets at any time. They want you to maximize mission and pay out everything, never have a liquidity target, never have any cushion. So kudos for those who noted the relationship between the federal cash flow problem and the financial restrictions placed on CTC by the United Way. Okay, let's see. Now, what's the way out for Ron, or for nonprofits in this sort of situation? I think I'm going to sneeze. Excuse me. Well, there are two things you can do. One is, right, to renegotiate the contract. Just say, I cannot financially exist if you're having these lags in payments. And while these lags in payments were very common in the late 90s and probably into the early 2000s, governments finally sort of figured out that they were killing their nonprofit partners. And so they have decided, in some cases, to take the contract, divide it in the annual contract total, divide it into 12 parts, give that amount to the nonprofit at the beginning of every operating month, and then afterwards reconcile expenses, reconciles the expenses to the allowable expenses to the amount of money that's been given out. And that way, the cash flow problem goes away. The other thing that Ron could do is simply break the contract, stop giving the services, and end the contractual relationship. And so he would stop providing the services, and over time, the lagged money would come in that he's owed, and that would hopefully cover most of his expenses if, in fact, revenues versus expenses in the operating budget were actually equal. Now, what will never be covered, though, are the interest expenses that he has incurred. I'm not sure if this is true of every single government contract, but anyone that I ever saw never allowed interest payments as an allowable reimbursable expense. So Ron's going to be in the hole for his interest expenses for those loans he took out, and he's probably going to have a hard time paying them back because I'm not sure where he, quote, makes that sort of money. But again, those are two ways out. I see I'm at 16 minutes here, so I'm long. Okay. All right, so the last thing I just want to talk about then is the coming week. And basically the main point here is simply that capital projects are for keeps, right? We just talked about how Ron could get out of his cash flow problem by renegotiating the contract or giving it back. But when you build a building, you're stuck with it. Maybe you'll be able to sell it at some point, but you've moved from liquid assets to fixed assets, and they're called fixed because they kind of stay around. So we come back to this notion then that your mission, your operating strategies, and your financial engine have to really be in sync. They have to overlap. You can't have mission out here and operations out here and, financial strategy way below the counter, out of the picture. No, you have to bring them all together. This goes back to Collins's hedgehog principle and the interlocking three rings, right? And so we're looking at that same simple notion conceptually in a more sophisticated way in the coming couple of weeks. And so we have an article about that this week too, linking money and mission, and it talks about how as your organization grows, you have to build these three capacities so that they balance out and can mutually support one another. One is mission and operations. One is the administrative capacity to manage your operations well. And the other is a financial capacity to actually adequately fund and adequately finance, have the cash to support these larger operations. And that's just a wonderful article, but think about the echo that it has back to Collins's hedgehog principle that we read at the beginning of the class. Okay? All right, 18 minutes, sorry. I think that's good for now. If you have any questions, give a call, and I'll see you online.